We're looking at the Dani Nedved case study on portfolio construction. Let's read that first question. Identify the most appropriate asset allocation strategy for the endowment and justify your choice. So we have MVO, which is mean variance optimization, or mean-CVaR optimization. So the main difference between these two is they're both optimizing for the asset allocation, but mean-CVaR, reminder that CVaR is conditional variance, is going to optimize more for left tail risks. And so if the endowment is more concerned about downside protection or left tail risks, then the mean-CVaR will probably be a better option than MVO. So let's take a look, read, and see what we get. Dani Nedved, a global institutional portfolio manager, is preparing for the annual meeting of Stanford University's investment committee. The endowment has assets worth $520 million, with a 44% equity allocation, 24% fixed income allocation, 21% private equity allocation, and 19% hedge fund allocation. The IC is primarily concerned with achieving the highest possible returns while maintaining a certain level of volatility to realize the most significant possible returns. Also, the IC intends to prevent a permanent loss of capital. That's important. And has expressed concern to Nedved regarding the possibility of left tail events in the future. Currently, Nedved is considering two approaches to the endowment asset allocation: mean variance optimization, MVO, and mean conditional value at risk optimization, mean-CVaR. All right, so kind of what we said at the outset: left tail risk, downside protection, loss of permanent capital. We're probably going to lean more towards mean-CVaR. So let's pull in the answer. Mean-CVaR, IC is concerned with left tail risks and permanent loss of capital. MVO assumes a normal distribution of returns, while mean-CVaR aims to optimize for minimization of expected loss beyond a confidence level. Therefore, mean-CVaR is more appropriate since it accounts more for that left tail in the optimization. Question 2. Determine the projected NAV for the private distressed debt fund by the end of this year. Left off right here, so let's read. Nedved evaluates a private distressed debt fund investment and examines the endowment's future liquidity needs. His observations about the fund are as follows. According to the most recent year-end financial statements, endowment investment in the fund had an NAV of $45 million. There had been a call for capital. By the end of this year, Nedved expects to pay a 20% distribution. It is expected that the fund will grow at a rate of 13%. So basically what we need to do here is we're going to take this $45 million, we're going to grow it at 13%, and then take out a 20% distribution, and then that'll be kind of our ending NAV. So let's pull in that workflow there. All right, let me do it right here so that we can still have the info up there. Okay, so our new NAV is going to be that starting NAV, which would be 45 million. And then we're going to add in the growth. That growth will be 45 million times the 0.13. So we're going to have about just under 6 million of growth. Add in capital calls, which is 0, and then subtract out distributions. This is the toughest part. So it says by the end of the year. So we'll assume growth of 13 and then do the distribution on that amount. So that gives us a little over 10 million. So we're going to add 5 million to the fund, or just under 6 million, subtract out a little over 10 million, gives us our projected NAV of 40,680,000. Question 3. Evaluate two potential risks associated with maintaining the investment in quantum alternative partners following the new capital inflow. Recommend one due diligence action for each risk. All right, so we left off right here. During his review, Nedved also examines two specific concerns regarding the endowment's alternative investment holdings. First, he notes that one of their small hedge fund managers, Quantum Alternative Partners, which currently manages 15 million, has recently announced it will be accepting a 500 million allocation from a sovereign wealth fund. So that's a big red flag here. We have 15 million currently, and they're accepting 500 million more dollars. I mean, good for them and their management fees, but may not be best for us as the allocator investor. Second, Nedved observes that the private equity portion of the portfolio includes several legacy investments that are in their final liquidation phase, showing exceptionally high reported returns over the past quarter. Okay, so the potential risks here due to the new capital inflow, let's pull this in. So two main risks we identified strategy drift. So the manager may be forced to invest differently with 500 million versus 15 million in AUM. So they may not be able to buy the same types of or same size of companies at that size. And due diligence item, detailed analysis of the manager's capital deployment plans, and then kind of reviewing that relative to how they've performed in the past. So if the capital deployment plan is significantly diverging to how they've kind of invested in the past, that's going to be a big red flag. Secondly, operational risk. The manager may not have the systems or staff in place to properly handle the large increase of capital. So then detail meeting there to assess the firm's hiring or technology plans to kind of handle this. And that's preferably on site, just because you can learn a lot more from being at the firm's site than you can over Zoom. Question 4. Explain why the recent performance of the legacy private equity investments should not influence future private equity allocation decisions. Briefly explain why the multiple of invested capital would be a more appropriate metric for evaluating private equity performance. All right, so we read part of this previously, but let's reread it. So Nedved observes that the private equity portion of the portfolio includes several legacy investments that are in their final liquidation phase, showing exceptionally high reported returns over the past quarter. The legacy private equity investments represent 3% of the total private equity allocation, but showed a reported return of 45% in the most recent quarter. The remaining private equity investments, representing 97% of the allocation, returned 11.2% over the same period. So let's pull in the first part of this, so explaining why the recent performance should not influence. The legacy investments are almost liquidated, as we talked about up here. So we shouldn't expect these to kind of be in the portfolio that much longer. And then they're also such a small portion of the portfolio, so should have minimal impact going forward. Therefore, little influence on allocation decisions. So that's going to be the first part of this question. Second part is talking about MOIC and why it's generally an appropriate metric for PE performance. So a couple things here. Long-term focused. So it evaluates total value created over the life of investment relative to investment capital. So it doesn't necessarily focus on those short-term results. It's really focusing on that long-term value creation and not taking into account when capital is kind of, when the returns are created, whether that's early in the life of the fund or investment or later in the life. And then holistic view accounts for both realized and unrealized gains. And both these benefits aim to kind of cut out short-term noise, returns, and aim to measure overall value creation. So there you have it. 2 parts there. You'd probably get 1.5 points for each of these 2 here. Or maybe 1 for the explain first portion and then 2 for the MOIC explanation.